So good morning to all of you. Thanks very much for joining us. I'm Anna Pinedo, a partner in the New York office of Mayor Brown. And Phyllis Korf and I are very pleased that you're going to be spending a little bit of time with us this morning. And we're very appreciative that our good friends at PwC have made time to join us, as well as Metar and Viola Gross. And so today we're going to hopefully make this as interactive as possible. So we invite you to ask questions as we're going through the material. We'll also save a little bit of time at the end for any additional questions that you may have. And we're going to start with some introductions so that you know the perspective that each of the panelists brings to the discussion. And maybe I'll invite Derek to start.
So introducing myself?
Yes, please.
Yes, good morning all. My name is Derek Thompson, Australian accent, been living in New York for 20 years. We have a small sort of specialized practice at PwC called Capital Markets Advisory, and it's made up of former investment bankers that, you know, we didn't like getting yelled at in 1,000-hour weeks, but we love the work. So we've formed a small group within PwC, mostly IPO specialists out of the New York Stock Exchange, out of UBS, and two of us are out of JP Morgan. And we started about 6 years ago, and we provide independent capital raising advice, specializing on IPOs.
Sam?
Great. Sam Zicko. I'm a director at PwC in our deals practice. I've been with the firm about 12 years. And I specialize on IPOs here in the New York metro area, particularly working with companies kind of 2 to 3 years in advance of going public, making sure they kind of understand the gap from what it takes to become a public company, and then helping them through, particularly around financial reporting and project management, to make sure by the time they get to, you know, a kickoff meeting for the IPO that, you know, their financial statements or financial reporting is kind of all in line, and they have kind of a plan to see through going public.
Michael, partner in the practice, the deals practice at PwC, run our IPO services group with these guys. 30 years at PwC, hundreds of IPOs under my belt. Would love to talk to anyone that's thinking about an IPO, whether it's a month out or 5 years out. There's a lot we can do to help companies, as Sam said, as they think through the process, both to go through the process of going public and then also to think through what it takes to become a public company. We have a whole suite of services that helps companies sort of get ready for that life as a public company.
Okay. Good morning, everyone. I'm Phyllis Korf. I am a capital markets lawyer. I don't know if I have hundreds of IPOs under my belt, but probably 100 at least, and very happy to do them for both U.S. companies and what we call foreign private issuers or non-U.S. companies. Over the course of my career, I've worked especially with some Asian companies, Canadian companies, and many Israeli companies. Also represent public companies after they become public. And also, along with Anna, do some late-stage private financings. Tomer?
Hi, I'm Tomer Shani from Metar, New York. We established the activities of Metar, which is Israel's leading law firm, in New York about 6 months ago. Myself and Karen is here with us. We are focused on representing early-stage Israeli startups. Many of them, will hopefully become late-stage startups, and many of them have become late-stage startups. So we also have a lot of expertise doing that at the pre-IPO stages, and obviously, when they do IPO, we also work on the IPO and going forward, as well as other exit alternatives. Before moving here, I have spent about 10 years with Metar, Again, focusing on early stage and then growing startups, and as well as the representation of various stage VCs and private equities who are active in Israel.
Hi, everybody. I'm Rafi Carmeli. I'm a partner at Viola Growth, which is part of the Viola Group, which is Israel's largest tech investment firm. It has early stage funds, growth funds, global co-investment funds in fintech, and credit strategy. And specifically, Viola Growth invests in sort of a bit more mature companies, so not early stage, and happy to share our perspectives as capital providers. And in my prior life, I was at Goldman Sachs, so happy to sort of flavor that with my experience over there on this topic.
Okay, so with that, we're going to launch in and talk a little bit about late stage or pre-IPO financings. And in many respects, late stage or pre-IPO financings have overshadowed IPOs. And our friends at PwC provided some market data that shows the level of activity. Derek, I don't know if you want to maybe comment a little on the trends.
Yes, thank you. Just briefly, the chart on the wall and in your presentation here, we just wanted to show you the depth of late-stage private financing. There's been a lot of press recently about the late-stage revival, if you like. Certainly, we believe as a firm that IPOs are not going anywhere. We had to sort of assure some of our clients, I guess, in the late...
Not going away.
Not going away, right. Yeah. Late last year, with some of the negative press. But it's interesting to see that the private capital, although it's slightly decreasing there, it's still very, very deep. Very, very deep. With like New Enterprise, NEA, Sequoia, I've seen a bunch from Andreessen, Bessemer, Osler, Klein & Perkins. There seems to be a lot of belief based on a potential future exit. One thing we did want to show you very quickly, this is the Money Tree report that PwC put out. So if anyone doesn't know what that is, jump onto our website. It's quite a brief document of 130 pages, but each page is broken down into a subsection of the market. So please grab a look at that.
What is that? The Money Tree report.
The Money Tree report, I got a lot of head nods, so I think people know what it is. It's a report on the venture capital environment in the U.S.
And Derek, can you tell us in your chart here, what would you consider late stage?
Probably 3 to 4 to 5 years away from a potential exit.
Mm-hmm.
So Series D, like strong Series D. Mm-hmm. We're seeing a bit of a decline in Series E and E pluses, obviously. But yeah, anything that's about 3 to 4 to 5 years, and then people start to think, okay, I could IPO, or I could do a trade sale, I could do a strategic sale, or I could link up with a VC or a PE and try and merge with another fast-growing company to get critical mass to IPO. But there is still significant and increasing interest. This concept of companies wanting to stay private a little bit longer, given some issues around WeWork, for example, that's real. So some of the concerns that the market has about path to profitability, which, and I don't know if you're allergic to or not, I'm a little allergic to it. I think it's more about scale and more about top-line growth. But some of the institutional investors that are talking about path to profitability, some of that has leaked a little bit to the investment committees in VC and certainly PE. And they're starting to use the word profitability, maybe 1 in 10 sentences instead of 0 in 10 sentences. Mm-hmm. But essentially, yeah, so this chart was just meant to show that the tremendous depth. VC is doing about 5 to 10 billion a week in the US. About 100 deals a week are getting funded, and a significant portion of that is late stage.
Mm-hmm. So to take a step back in terms of rationale, there are any number of different reasons why a company might do a late stage or pre-IPO round. certainly, it's the company, to Derek's point, may want to defer their IPO for a period of time, whether because they feel that they're not ready for an IPO, they have certain metrics that they want to achieve that are going to get them a higher valuation at the IPO, or they don't really want the burdens associated with being a public company. For other companies, the rationale is quite different. They may have funded themselves early on with friends and family, angel investors. They might have a complex capital structure. That's often the case with companies that are domiciled outside of the United States. Israeli companies often have more complex capital structures than do U.S. companies, for example. And the pre-IPO transaction may well be a means of addressing and, as we say, cleaning up the cap table. So it might involve an infusion or injection of capital into the company. The company might use some of that to take out existing investors and simplify things. It has become significantly more common in the last 2 to 3 years that investors will be willing not only to take and invest in new preferred stock, which is the typical structure, but also invest in ordinary shares or common stock held by employees or early investors. So there may well be a number of different motivations. And then, of course, finally, there may be a strong desire on the part of the company as well as on the part of its financial advisors for the company to bring in well-known U.S. institutional investors to provide some validation and also to provide some validation for the company's valuation and business story, as well as to bring in strategic investors that offer more than just the capital. So maybe I'll pause there and ask Tomer and Rafi to comment a little bit on some of the rationales or the motivations that they've seen.
So I will say a couple of points on what you just said, Anna. I do agree that the capital structure of Israeli companies used to be much more complicated than you would have seen in Israel. This was predominantly attributed to the popularity of participating liquidation preference in Israel, which was widespread until 6 or 7 years ago, and is still very much noticeable in late-stage companies, which right now reach or attain the stage of pre-IPO or pre-M&A. Or late-stage investment generally. However, in recent years, we've seen a very clear trend away from participating liquidation preference, which has gone a very long way to simplify the capital structure of Israeli companies. So I believe that this is probably an issue that will still be faced in IPO stages of Israeli companies in the next few years, but probably not for too long. So that's just kind of like one observation. Another interesting data point is that while the number of late-stage investments in Israel has constantly grown over the last few years. Last year we had 38 late-stage investments in Israel, and we define late-stage investments as investments of more than $30 million, compared with 34 in 2018, and much less than that. I can't remember the number in 2017. The number of IPOs has at least so far, remained pretty steady and not very high. Last year, 4 Israeli companies IPO'd. 2 of them were in the space of either pharma or medical devices, and 2 classic Israeli software companies. One cyber security company and another gig economy Fiverr company that went public. And this trend, by the way, has not changed over the last decade. Since 2010, there's been more than 1,300 exits in Israel, and less than 50 of them have been IPOs. And by the way, that has not always been the case. In the previous decade, there were quite a few IPOs. Not all of them have been a huge long-term success, which probably resulted in some reluctance both on the part of Israeli companies and on the part of investments to take Israeli companies public.
In 14, there were quite a lot.
In 14, 14 was the peak year of this decade, and yet there were 20 IPOs in 2014, which again is not a lot. By the way, I mean, I'm only referring to IPOs in U.S. markets. Again, last year there were like 6 or 7 IPOs again, not to be offensive. Well, one was in the UK, but the others were in smaller markets, and I obviously don't mean to offend anyone, but this is not what I guess everyone around this table refers to when using the presumptuous word IPO. Just to be clear, I'm talking only about that. Mm-hmm. Now, in terms, the difference or this delta between the number of successful late-stage investments in Israeli companies and the much more humble number of successful IPOs is something that, at least in my prediction, will have to be addressed one way or the other in the next few years, because companies that raise at unicorn valuations have very limited M&A opportunities, which pretty much means that IPO will be, at least for some of them, the only option. So, assuming that the other stance will align, my personal prediction is that we will be seeing many more IPOs in the years to come.
Okay. Well, maybe with that, we'll dive into some of the process issues and the types of securities, and Rafi, feel free to interject in terms of what you see versus what we are describing.
Sure. Just say, and maybe an opening remark from our perspective as a capital provider. Can everybody hear me? Historically, there hasn't been that much private capital in these amounts, and the only way to raise a large sum of money to continue the support of the company would be an IPO. Since the venture growth and other sort of forms of capital emerged, and the biggest one of them is probably SoftBank, opened up this category of there's abundant amount of capital out there that can continue to support a company, that is basically replacing as the public market as a source of capital. And again, an IPO is not really an exit, it's a means to liquidity further down the road. And you go to the public markets to get Fidelity, T. Rowe, and other investors to provide capital to continue the path of success of the company. So that is what has caused the evolution. I agree with Tomer when he says, as the company becomes bigger, it's more complicated to find somebody that's going to buy 100% of the company, and you probably need to find other sort of private or public capital that will buy pieces of your company. The other sort of dynamic, I'd say, is that the IPO market historically has supported much smaller companies, at least in the tech sector. It's still true in other sectors. And you can no longer go public if you're not above a certain size and you have the scale and maturity that public investors want in their portfolio. So in order to get there, you just need more private capital.
So just diving in a little bit on the terms of some of these late-stage rounds, and we'll go through this relatively quickly unless folks have questions. So largely these are transactions where the security that's being sold is a preferred stock that is based on the prior series of preferred. Occasionally you'll see a debt-like security that is very equity-like, and when I say very equity-like, deeply subordinated, has equity-like features, including interest payments that match the dividend payments on the company's outstanding preferred, convertibility features, some sense of warrant coverage. I would say that as between the two, preferred stock and this equity-like debt, where the overwhelming majority of transactions are preferred stock.
Yeah, I would agree with that. I do have to, and I also agree with your previous statement, Anna, which I should have addressed earlier, that quite a few late-stage investors, at least in Israeli companies, are now willing to purchase, especially through secondary acquisitions, not just the top of the stack type of securities, but also more junior securities that are not necessarily the most senior shares of the company. The funny thing is that it looks like late-stage investors have generally relaxed a little bit about the legal and general economic terms they are expecting in late-stage acquisitions. I mean, Karen and I have...
You're dealing with nicer investors than we are.
Probably. No, I mean, but it's a seller's market. You know, I'm like, we recently had done a deal of like a $35 million bridge deal, which is something we would not have seen in Israel, at least until a few years ago. And I mean, generally speaking, it looks like the sophisticated investors who expect to take companies public don't want to to place too much burden on the capital structure of the company by putting in place terribly sophisticated economic protections, which is something we used to see very often in previous years. Again, I mean, like
But isn't that because they're hopeful it's a bridge to the IPO, right? So they see the light at the end of the tunnel.
They see the light at the end of the tunnel. I think some of them have had bad experience trying to IPO or sell Israeli companies, and having to do it over the strenuous opposition of minorities that were not terribly happy about it. Israeli law does not provide very clear guidance as to how to deal with minority protest. And the result is that if you want a seamless process with an Israeli company, even if the result is not what everyone had hoped for, the better way to do it would be for the legal and capital structure to be as straightforward and simple as possible.
Okay. Well, taking a step back and just speaking more broadly about the market, generally, not limited to Israel. So what we see are preferred securities with a liquidation preference. The last round in is going to insist on being senior to all the prior rounds. By and large, they're going to want participating preferred in the United States. If it's participating, generally it's not capped. They're going to want a dividend. In late-stage rounds, we frequently, again, depending on the time to IPO or projected time to IPO, we'll see a redemption right, or at least a request for a redemption right. And, of course, anti-dilution protection. So the anti-dilution protections often will also include some protections, including an IPO ratchet and an M&A ratchet. So in that regard, the last round investors want to make sure that if the company is going to undertake an IPO or an M&A exit, then they're going to at least have a certain guaranteed rate of return. And if there's a valuation or exit event, that's going to come at a price that where they're made whole on their investment. So that raises a number of issues with respect to the IPO or the M&A transaction. It's something to carefully think about. In terms of participation rights, rights of first refusal, rights of first to offer are fairly common. In all of these transactions, because you'll be dealing with institutional investors, their expectations are going to be that the company is going to give very fulsome representations and warranties regarding their business. And so oftentimes the representations and warranties that are expected by a late-stage investor are going to be more detailed, more fulsome than what you would expect to be requested of by an underwriter in an IPO.
A question, Anna, I mean, like, what is your take on the question of whether rights such as the ones you just mentioned, such as right of first refusal, co-sale, and what have you, whether they should expire automatically upon an IPO or a qualified IPO?
Yeah, they must.
Yes.
No, I mean, should it be only qualified IPO or any IPO?
Lately, we have been revising those provisions to contemplate an exit. So not necessarily a qualified IPO, the old style definition where it was a listing on a stock exchange and a raise of $X or a valuation of $X. So we've been writing them a little bit more liberally to contemplate the possibility of a direct listing as well as just to contemplate a listing, period.
Do you see a difference in, because the term late stage is very broad. You know, we heard some, above 30, and there's a big difference between a company that's raising $30 or $40 million, which is a more mature company, but by no means a company that's raising, similar to a company that's raising 100 or 150 million. So maybe you can discuss the differences, because the type of protection and what the investors are looking for in a $150 million raise versus a $30-40 million are probably different. So do you see any?
No, they're absolutely quite different, and we don't think of we don't think of late stage or pre-IPO as defined by a dollars raised perspective. We think about it as time to a liquidity event, be it 12 to 24, maybe 48 months to a liquidity opportunity. And so crossover investors, institutional investors, and I would include family offices, the traditional mutual funds that that can now invest in IPOs, as well as strategic investors, have a very different perspective if it's just growth capital versus capital that's funding to a liquidity event.
Mm-hmm.
So in that regard, they will want protective provisions to your earlier point. They will want to negotiate affirmative covenants and negative covenants that protect them and remedies for failure. However, they may not be as involved as a venture investor or a growth stage investor. Largely, the investors in late stage and pre-IPO rounds are passive. They don't want controls. They don't want to necessarily be considered affiliates when it comes time to the IPO. Mm-hmm. They certainly don't want to be considered affiliates when it comes time to locking up in connection with an IPO or release of lockups. So they do indeed bring a different perspective to the investment and to the terms, to your point.
And do you see a difference between the type of investor, if it's GA, which is a late-stage growth firm, versus if it's capital that's coming from a public institution like Fidelity or T. Rowe that come into the sort of a crossover round? Are they thinking about these rounds differently? They're
thinking about these rounds completely differently, and sometimes that's the art in pleasing the multiplicity of investors that will come into a late-stage round. So just flipping along, if you think about the considerations for crossover funds, they're indeed very different. So a crossover fund is less eager to have board representation. That is usually not something that they care greatly about. They're more interested in seeing their rights protected through affirmative and negative covenants. They want information rights. They want access to the company and to regular reports, which leads into some of the pre-IPO planning discussion that we'll turn to in a moment. They certainly want to see financial statements. They want to see these IPO provisions and the ratchet, but they do have a very specific timeline to a liquidity event. And so they come at the investment with the perspective that they're costing their investment in the company. They want to come in at the late stage round. They, assuming that the investment has gone well, they're going to be anchor investors in the IPO, which is part of the appeal of doing a late stage transaction. You're de-risking the IPO. So they will view it in that light. I don't know if that's consistent with your experience.
Yeah, no, definitely. I think it translates to all the, if you look at a term sheet that's coming from these two institutions, it will look very differently, and the company should, if it has all the options in front of it, should choose, between these two things. It's very different profile of investment, and so I totally concur with your point of view.
So the last point to mention before we wrap up and move along is just strategic investors. I would put them in yet another bucket. So strategic investors are often brought in to late stage rounds. We tend to like to see them brought in a separate round as opposed to trying to get crossover investors and growth investors and strategics on the same page. So with strategic investors, there are going to be a myriad of considerations that don't exist with the categories that Rafi, Tomer, and I have been discussing with the growth investors and the crossover investors. With strategics, the company has to worry about whether the strategic investor is also going to be investing in other companies in the same sector. And to the extent that they're investing in your competitors, are they doing that as a means of sort of hedging their investment in their sector and trying indirectly to pick a winner and align themselves with a winner? Do they have information that they're going to receive from your company that you don't want them to use in connection with their investments in competitors? Are you going to allow them, or are you going to negotiate some prohibition on their investment or on their degree of participation if they're already invested in competitor companies? With strategics, you more often worry about negotiating standstill provisions. You don't want to negotiate a price and terms with a strategic investor and have it be an incipient takeover and allow them a clear path or an inside track to an M&A opportunity where they have the inside track or they're seen by other prospective acquirers of the company if an M&A exit is a possibility. And have that be sort of a chilling effect. So there are quite a number of considerations. I'm going to back up before we turn to IPO and just talk for a tiny bit and ask Tomer and Rafi and Phyllis to comment. So the timelines for these transactions are very fluid, and it largely will depend on how closely the transaction terms and the dueling term sheets that you often see in this context, how closely they align, how closely the terms align maybe to prior rounds of financing. But generally, this is a process that can easily take 4 to 6 months. So it's not
as long as an IPO.
Yes, it's not an insignificant investment of time. And as Mike, Sam, and Derek will talk about, a lot of the prep work that is done for this late stage round is going to be incredibly helpful and dovetail into the preparation that companies are having to do with for their IPO. So in terms of process, usually an engagement letter with the placement agent, so an investment bank, is incredibly valuable in guiding this process. Most companies are only going to produce an executive summary or a company presentation in connection with this effort, accompanied by a very, very fulsome financial model that is going to be shared with investors that have been identified by the placement agent after they've signed an NDA. And perhaps the process that requires the most work is working with counsel and preparing a data room. So a data room that has all of the type of information that both strategic and institutional investors are going to want to see. Sometimes that data room has various sections that are hived off for different purposes and for different types of investors. Of course, different types of investors will have different preferences in terms of what they require from a diligence perspective, what they require from a financial model perspective. A lot of that is also going to be conditioned on how far the company is from an IPO and how much you feel comfortable sharing with investors if an IPO is a near-term event.
Yeah, I would just comment, I mean, again, agree with all. The only comment I'd make is that what we recommend to our companies that are typically a little bit earlier than the crossover when we enter, but their next step might be a crossover round, is if they don't have it already, they should maintain a data room as if they're going to raise a crossover round or go public always. So this should be their constant basis of preparation.
Because
So,
otherwise, it could take months to put up.
Exactly,
Yeah.
and it looks, and it's just, it takes too much focus from the ongoing operations of the business. If you have to just prepare for this, if it's there and you just add on it and refresh it on a quarterly basis, then it's not that much of a deal. And obviously, it's never going to be 100%. It never is 100%. But if you're 80, 90% there, then it's not that much of a hassle, and it's just good business practice.
Mm-hmm.
So before we transition to discussing the IPO market and IPO readiness and preparation, any questions on late stage and pre-IPO investments? So hand it off, Derek. I think you're gonna.
I would make another couple of observations on a couple of points that you mentioned, Anna. I mean, first, I think the presence of strategic investors in the Israeli market has been a bit more problematic, for lack of a better word, than it has been in other places. I mean, like quite a few Israeli companies have sold themselves effectively to strategic investors without actually understanding that that's what they were doing. I mean, by providing strategic investors with terms that pretty much allow them to prevent any sale or an IPO to anyone else, and thereby, and again, I'm like, you know, this is probably attribute to some historical lack of sophistication, which may no longer be the case within the Israeli market, but definitely was the case until a few years ago. And I think that for that reason, strategic investors raise more concerns, more intuitive concerns within the Israeli market than they do elsewhere. In recent years, we've noticed the rise of CVCs, of corporate VCs, of like VC arms of strategic investors which have tried to play the role of something in between, of neither strategic nor financial investors. They oftentimes argue, I mean, I can, explain with a lot of zeal and passion about the Chinese world that exists between the VC arm and the corporation, which I have to say that in my experience doesn't really exist in practice. I mean, when you get an investment from a CVC, you get an investment from a strategic investor. I think that's kind of like a point that has to be clear for everyone. Another point I wanted to touch upon, which is, again, I think a bit unique to the Israeli market, and that is that the Israeli market is struggling with placement agents, with investment bankers, and generally, many and obviously I don't.
Struggling meaning there's too many of them, or?
Struggling meaning that we are not very good at working with them. I don't know if you will agree or disagree, Rafi, but I'm not sure that it's
struggling for paying for the service. That's the real struggle.
As an Israeli or a service provider to Israeli companies, I can tell you that they generally struggle about paying the service providers, but but we're not here. That's probably beyond scope. But generally speaking, I do think that, they don't always appreciate the value that placement agents can bring to the table. And that said, I also think that placement agents have not always properly understood the Israeli market and have tried to go about it the same way they would have gone about the U.S. market, which in many times has led to literally to cultural clashes that interfered with the conduct of a seamless process. So again, just a couple of random observations.
Mm-hmm. Mm-hmm.
Just one, interestingly, the investment banking pricing model of this 7% around the 100 mil and then to 6% around the 300-400 mil and 5% around the half a bill. If you look at professional services, they've all sort of come down as in competition has increased in price, and technology's been able to bring their overall price down. But the investment banking prices for underwriting an IPO 40 years ago, 30 years ago, they haven't moved an inch.
But it has,
They're exactly the same.
no, but
Yeah.
I'm not speaking from that hat, but it's condensed because you have many underwriters now on a single IPO. So maybe the 7% is still there for an IPO, but that pie is split between many more. And in a private capital raises, it's still typically just with one. So maybe the economics of doing the deal, I think, I'm not sure it really changed. I think there's a big difference between if you go for a crossover round and without using sort of a dollar amount, but I think it translates also to dollars amount. It makes more sense to take a placement agent because you talk to investors that are used to conversations and being approached by placement agents. If you start doing something that looks and feels more like a growth round, then the investors are not often used to it, and then sort of it raises questions, why are you using an agent? Is there something I should be worried about? So there's sort of, it's still unclear for some companies when the benefit sort of overtakes the cost and the concern. I don't think it's really about just the money, and it also depends on the skill set and the quality of the team. Are they able to do it on their own? Not all teams have the experience, the skill set to pull something as complicated as this on their own, and they may need sort of the support of a service provider.
Mm-hmm.
So there's two observations.
So maybe we'll turn to the IPO market.
Certainly. So we have a few slides we'll run through fairly quickly. I just wanted to sort of take a look at the U.S. IPO market. Our first observation is around the economic environment in which we see IPOs operate. So we've had a strong run-up in the S&P, a strong run-up in the S&P and the overall equity markets. Reasonable economic growth, as we all know, in the U.S. So that's a good environment for investors. So there's a fairly good anchor around valuation at the moment. So there's a lot of discussion about are markets overheated? Is the crash coming tomorrow afternoon at 2 o'clock?
Mm-hmm.
If we look at the S&P sort of pricing multiples, they're actually not bad. It's sort of 16, 17, 18, 19 times. As an investor, that's not unreasonable, right, in terms of PE. So although there's a lot of concern, the fundamentals still seem to be there. So investors in IPOs still feel fairly confident that the underlying structure of the market and their ability to trade their stock in a liquid market is going to remain for some time. That's a very general statement about the economic environment that the IPO investors are operating in. The next page is how IPOs have been doing as a market. We had 196 IPOs last year, 56 billion. So just to compare that, that's about half the size of the VC market. A slight decrease in the number, but a slight increase in proceeds. We had Uber in there, grabbing $8 billion. We had Snap and Lyft. So we had a few good IPOs. The second two charts are interesting from an investor perspective because we want to see how the market is reacting generally to the product that's been brought to investors. So if we look at the pricing dynamics as to whether the IPO is priced above the range or below the range, it probably hasn't done quite as well in the last quarter. You can see the blue line there is a bit smaller. But it's certainly in the second and third quarters, 23 and 24%. So that means about a quarter of IPOs have priced above the range. So if you go in with a $15 to a $17 price range, there's been sufficient demand, which we can read dry powder, and bankers have to earn their livings as well. And just as we're always looking
money. Their job is always to place money. So a little bit to your comment, it is a bit of a seller's market, actually. There is a lot of money out there looking for good deals. And this sort of reflects that a little bit. And also whether IPOs, the second chart here, are upsized or downsized. So should we issue another 5 million shares? Yes, the market will gobble that up because the offering has been oversubscribed many times. So this is all pointing to a fairly robust history. Of course, we're not making predictions, but right where we are now and where we've been the last few years is a fairly solid IPO market with quite a bit of demand from institutional investors.
But a lot of them get downsized. Their range gets decreased before they're priced. So,
which is a great point, and that's all about readiness.
yes.
Yep. If you've really done the work as an issuer and you've gone through the pricing range, you've worked with your investment bankers to try and understand where the demand might be, you can trim that price range and mostly get it right. If you haven't and your price range is all over the place, investors just have coffees just like we do, and people talking about a company that's going all over the place in terms of valuation. So it's very important to work with your advisors and get that price range right. Yeah, couldn't agree.
Do we have any information, physical information about the gap between the last round and the pricing eventually at the IPO?
Like the last private round?
Before?
Absolutely, yes.
Yes.
Step up. Yep. We use a Pitchfork or CB Insight. They track the last private round, and the step up is like 1.5 or 1.8 or 2 or something like that. Yeah, it's not the 20 or 30 times from the seeds and the early rounds.
But a lot of the large ones, including Casper that everyone is talking about now, they've just decreased their price range. They're no longer in unicorn level. I think their valuation now is like $750 from where they were, and it will be down from the last private round.
Yeah.
Growth VCs look at it because they are around in the unicorn area, and knowing that when it goes to IPO, it could be lower than that.
I mean, it's not, it means they overpaid. Whoever did the prior round believed in a story that didn't manifest itself, at least for now, or the public market investors are looking at something else. After, I think, some business models have proven to be shaky, the investors that believe that this is going to be a public market outcome look deeper into unit economics. And I haven't spent that much time on Casper, but one of the issues that suddenly popped out is that the unit economics there are not as favorable as people have hoped, and maybe the trajectory that the prior round looked different. It just didn't happen. So I think it's relatively uncommon. 1.5 is very reasonable. It's actually a good return if it's in 2 years. That's around 25% a year, which every investor at that stage would be happy with. And again, they're investing not for those 2 years, as a comment was made earlier here. They want to stay with this company for the long run and ride the performance post-IPO. A lot of value is created post-IPO. Many investors forget that. Many venture capital firms leave that money to somebody else, which is sometimes, most of the money that they can make can happen after the company goes public. So again, an IPO is a step. Should be viewed as a step for everybody, for the company, for the investors that have invested earlier, and for the crossover investors.
Yeah, I will say that, at least specifically for these very markets, there simply isn't enough data available to assess, to come up with numbers that would have any meaning because of the very limited number of IPOs that have been consummated by Israeli companies in recent years. I will say that it is pretty clear, again, the difference to which which I addressed earlier, between the number of late-stage investments and the number of investments that actually resulted in an IPO. that it is a kind of like, self-telling that quite a few investors have invested in another star that was not in the north, that, that did not manifest itself in the manner that was anticipated. Again, if judged by the number of late-stage investments in Israel, we should have had many, many more unicorns than we actually have. So, again, this is, that point is pretty clear.
And many more IPO candidates.
And many more IPO candidates, which, again, I believe will be the case. I believe we will see a rise in the number of Israeli IPOs in the years to come. Again, Israel will at some point align with the rest of the world. There is interest in IPOing Israeli companies. I don't think there are tremendous specific difficulties that would set Israel apart from the rest of the world. But then again, it is also a fact that it does not happen so far.
Mm-hmm.
Yeah, by the way, I'm not sure that the percentages are different for Israel than any other, even the U.S. market. It's just there's less stories, so there's also less IPOs and less exits, and there's many more stories in Silicon Valley, so you think there's more IPOs, but I think on a percentage basis, it's probably very similar.
Yeah.
Absolutely. The only thing I'm saying is that, you can't have any meaningful data, such as, what Derek was referring to before about, multipliers you can expect when you invest in
from crossover to
yeah, exactly.
So Derek, maybe you can take us through the rest of the market slides.
Yeah, certainly. So just this slide is obviously pertinent for today. So we've seen 7 Israeli IPOs over the last few years. So a Maya Brown one, in mode, I just got some stats here, 180% up.
Yes.
Congratulations.
Yeah.
Amazing.
Before anyone jumps on that. Very quickly, we wanted to go to the next slide. This is about IPO windows. So we hear a lot about this. So there are good times to IPO and there are difficult times to IPO. And if you've been around sort of long enough and watching the IPO market, so if you're thinking about maybe doing an IPO in 2 or 3 or 4 years, start watching now and see what's going on around in the marketplace. You can see what the Fed is talking about. You can see what economic growth is looking like. You can hear stories about trade concerns, what the consumer is doing, what inventories are like in the U.S., and some of the technological advancements that have become mainstream. And you can sort of get a sense of how the markets are moving. So if we look back sort of 20 years, we can see there's a few windows of opportunity. So we've highlighted them here. For example, we've also put E there for elections. So we've had a reasonably slow January. 2020 is off to a bit of a slow start. But there are a tremendous number of IPOs in the pipeline that really want to get public before, say, the July holidays, because that's the start of the close of a window as we get close to the election. So uncertainty increases, investors are less confident in their valuation anchors because they start to move around a bit depending on U.S. government policy. So that's an example of a window. So if you're thinking of IPOing in the next, say, 12 to 18 months, your board says, let's think about that. You might go, well, we can't make it in, say, by June, July. So then let's just maybe blank out the second half of the year. So let's not consider until maybe March or April, because we get the first, annual results audited by then for the whole of this year. So you can start to see a window for me. And Mike and Sam will go into that in more detail in timelines. Just some themes. These are good fun to remember, because when you're sitting on your road shows and investors are giving you the glare, they're expecting you to talk about some of these items. Top line growth, obviously, we talked about some of the VCs bailing out a little early, maybe, when they get out of IPOs. They would be a bit disappointed if they look back and saw some of the post-IPO value that's clean. And a lot of that comes from the top line growth. So a lot of investors are looking for large markets, large scale, and if you're in a large growing market, you will get value for that.
When you say large market, At the crossover or IPO, what is large?
Large is like a supranational or a regional global. So if you have a technology product in the US and Israel, for example, can that then go into Europe? How is it scalable? Can you get that platform scaled into Australia? Yay. Right? And then can you go maybe up in the luxury market, or do you go down to the sort of value conscious consumer? Yeah, it's expanding that.
But you don't have a number, sort of, they don't look for an addressable market that's 5 billion, 10 billion, 2 billion. What's the...
Well, that largely depends on the size. If you're raising 100 million as an IPO, you might want a $2 or $3 billion addressable market. If you're raising 500 mil, you might want an $8 to $10 billion addressable market. And also, it's a function of microeconomics. So how many competitors are in that marketplace?
Yeah.
So how realistic is it for your company to carve out a niche and to get 4% market penetration? Or is it a 25% market penetration at a smaller business? So it's a back-to-school corporate strategy. Hire McKinsey for $7 million a month. Yeah, but
they'll give you the answer.
So just very quickly, top line growth. So the box below that, experience management team. So that's the execution team. So investors are looking for you to execute and to capture that market share. And have you done it before? Many early companies haven't done it before, which I think is great, right? As long as you have some experience around you, don't be afraid to. Not everybody has to have done everything 10 times. Investment community, okay.
When is the appropriate time to change your C-level team? So let's say, is it risky to change your CFO 2-3 months before, or is it risky to change him a year before? Like, when is it done?
We quite often get that question. I'd say, you want a team that knows the business and that can talk about the business and that's got experience in the business, but at the same time, generally you want someone that's got sort of public company experience as well. And very often that CFO or CEO that's sort of taking you to the brink of IPO doesn't have that experience. Typically for a CFO, you don't want to be bringing them on the week of the IPO, although that happens.
Yes.
I've worked on a couple. Actually, I worked on one a few years ago where the CFO's first day was the roadshow.
Yes.
That was kind of a challenge. I would say generally a year in advance, you want to bring in that team so that they can go through the process of preparing for the IPO, help the team to get ready, and then by the time they're on the roadshow, they have some experience of the business and they can talk knowledgeably about the company. I mean, that expands not just, to the CFO, but, the entire finance team and then the C-suite team. Although, a lot of the prep work does focus in sort of the finance team. So we spend a lot of time sort of helping finance teams, CFOs sort of get ready that sort of year plus in advance of the IPO. So generally, I would say, you want to start acting like a public company about a year in advance because there's going to be teething trouble as you sort of go through that process.
And also get your audited financial statements done.
That's obviously a whole
a whole separate conversation.
But for the CFO specifically, I would say, start thinking about a year in advance.
So just to finish the market overview, final slide, just looking at the sectors that investors are very interested in. TMT, you can cross that out and just write technology. Pharma and life sciences, you could almost cross that out and just write biotech.
Mm-hmm.
Obviously, high growth, a little bit of a risk in there. Investors are looking for returns. Quite an interesting thing, of course, is SPACs, so special purpose acquisition companies or blank check companies. There's sort of a bit of a resurgence there. I think a lot of people have been, maybe 5, 6, 7 years ago, a lot of investors were a little bit concerned about what the SPACs would do.
Mm-hmm.
I think the SPACs have proven themselves. We've got some big PEs in there. Goldman Sachs did one, I think. Carlyle's done one. They seem to be making reasonably good investments as a whole. So investors are very happy to see them out there. I mean, like maybe half actually are successful in finding an acquisition, and the other half just sort of float away and close down. Okay, that's any questions on that? Yeah. If
you want some information on step-ups, for example, just let us know with oodles of data that we use.
No, go ahead. So I guess as I think about kind of the IPO process more broadly, we kick off sort of the whys and the whens. I guess from a when perspective, I always think about really three sort of intersections. The number one is sort of when's the business ready? When's the right story? When does the company get critical mass? And, with prior rounds, when are they kind of ready to become that public company? You've also got to think about the market windows, which sort of Derek talked about. Is the market ready to accept this company? Will sort of the IPO, will the market be open for this IPO? But the third thing, and the thing that we spend most of our time on, is this company ready to be that public company? You sort of almost can't, influence the first two, but you very much as a management team can influence the last one. The last thing you want is your CEO saying, okay, we're ready to go, the market windows are open, you turn to the sort of the GC and the CFO and they say, okay, let's go, and you say, oh my goodness, we've got all these, 1,000 things to do, we weren't ready. So we spend most of our time helping companies get ready for sort of that event. Generally, we're talking to companies, let's say 2-3 years in advance as they start to think through that process. Maybe 2 years out, we'll do what we call a readiness assessment. We just did a survey recently where the last 5 years of companies we went through and looked at, who's sort of gone through an IPO and what have they done a readiness assessment. About 2/3 of those companies have used an external firm to do that readiness assessment. The other third have sort of tried to do it themselves, and I think 1% didn't do anything, and those are probably the ones that struggled. But, the vast majority of companies do some sort of readiness assessment, let's say 2 years in advance of an IPO. And what do they do there? They go through a whole framework, and they think through, what are all the activities that we're going to have to think about as we go through this IPO? What's the information that we're going to have to put together as we pull that registration statement together? Do we have audited financial statements? Have we had acquisitions that we need to get information for? Do we have our cap table? You'd be surprised the number of companies that I come across where they just, quite frankly, don't know who owns the shares and who owns options, and just sort of getting all of that cleaned up, getting that information ready. We talked about a data room. Generally, companies that have gone through pre-IPO rounds have done sort of data rooms and they've got things ready, but when you get to sort of the diligence process in the IPO, all of a sudden it becomes real. And now you really need to find that stuff and you need to pull it together. So really getting ready for that sort of IPO transaction is really the sort of the number one thing to sort of worry about as part of that readiness assessment.
So Mike, sometimes when we're working with companies, we give them a typical due diligence request list that an underwriter might request of a company in that industry or sector, and work through it with them, and you'd be surprised some of them don't have their corporate minutes.
Right.
So we have to kind of reconstruct that, but other than that, they'll see all the other areas where they have done nothing or where they're going to need to answer questions, and they can then get the help if it's early enough in the process.
Yeah, and that's what we call sort of going public, getting ready for that operation of sort of pulling the registration statement together, working with the banks, the lawyers, ultimately the SEC, and sort of getting the money in the door. But I think, even though most of the focus ends up being on that, most of the companies trip up because their organization isn't ready to be that public company, sort of what we call being public. And we have a sort of a whole framework that we take companies through. I think it's in here. This one. And as I think through sort of what does it take to become that public company, this is the framework that we use, and these are the areas that companies typically have to either create or beef up as they become that public company. From our perspective, sort of the heavy lifting is probably the top row, but we really like to think through the sort of the entire page. So just to sort of scan through maybe the top row for a minute, sort of accounting and reporting. Unfortunately, the longest pole in the tent or the problems always seem to occur in the accounting and finance group. It's sort of easy to point the finger at the CFO, but, unfortunately, that always seems to be the area. And accounting and financial reporting, there's a lot of information that goes in the document. There's a lot of information that has to be ready. The company has to be ready to release once they become a public company. It's timely and accurate financial statements. That first quarterly, that first 10Q seems to come around very quickly. And if you haven't sort of thought about being able to put your financial statements together within 45 days, it's very hard to do that in your first quarter. You need to be planning for that well in advance. What does that mean? That means a lot of documentation, a lot of revisiting accounting decisions. There's been some significant accounting pronouncements in the last couple of years around revenue and leasing. A lot of companies have had to spend 6 months to a year thinking through those concepts and how to put the documentation in place, get their auditors satisfied, and get through sort of the implications of those two accounting pronouncements. Finance effectiveness is a little bit more about that finance team and the CFO's sort of operation of the CFO, thinking through maybe your FP&A group. Generally companies are hiring some additional accountants, they're hiring additional FP&A function. They're now more able to plan, forecast, put guidance together, put those models together, the information that the banks need. A lot of information that probably that hasn't been put together in the same amount of detail in the past now becomes front and center. Internal controls, companies spend an awful lot of time thinking through the implications of SOX. Generally, what we talk to companies about is about a year in advance of the IPO, they want to be thinking through what does your internal control structure look like? Do you have any significant deficiencies? Do you have any material weaknesses? If you have material weaknesses, you really need to get those identified, flagged, fully disclosed in the document, and then any remediation plan to get that fixed really needs to be sort of underway well before that first S1.
Yes, because it's going to have to be disclosed and described, and you want to have the remediation plan.
Yeah, we see, we again have another survey that we put out at PwC on material weaknesses, but, most of the companies I tend to work on tend to be tech companies in the market around here, let's say 100 to 300 million in revenue. The vast majority of those companies have material weaknesses. Even if you look at what's disclosed at the time they go public, it's about 50% of those companies have material weaknesses. So when we start working with them, I feel like I go in expecting them all to have a material weakness. It used to be sort of a bit of a black cloud when we started doing this 20 years ago when SOX came in. Now it's almost a case of you really need to get that identified and disclosed, and if it's disclosed in the document and you've got the remediation plan around it and it's not going to impact the reliability of your numbers, it really doesn't seem to impact valuation. Plenty of companies go through an IPO process with a material weakness, and they just work through it. There's no problem. In fact, I would say material weaknesses, plural, seems to be the common these days. But you certainly need to get your arms around it, and the worst case scenario is you don't disclose in a document, and then you start to get closer to your actual compliance, and now you find a material weakness. You surprise the market, and there's been plenty of companies where that's happened, and it's had a big impact on the share price.
Yeah.
I would just add maybe one comment, because all of these are technicalities that always appear and can be solved and will be solved if the company wants to go public. I think the first step in preparation is sitting with the board, the leadership of the company and the board, to decide if an IPO is the right answer for the company. And if that's the story that will get the company where it wants to go. Does it have the sort of the ingredients of a successful IPO that the public market, public investors will want to hear? Do they have the market leadership? Does the company have a buzz that sort of justifies that alternative? Does the company even have other alternatives or not? And if the answer to those are yes, then go ahead and deal with the mechanics of getting ready for an IPO. But don't sort of skip that step to make sense if strategically this is the right decision for the company.
And I would say very often we get companies that are 2 years out and they're sort of floating that idea, and the board and management, quite frankly, don't understand what it's going to take to go through a process like this. And they've sort of seen their friends, they've seen their peers go public with significant multiples. Wow, that sounds like a great answer. But then when they sit down and go through an exercise like this and realize it's going to cost literally millions of dollars to sort of get them there, many of those companies sort of back off because they're perhaps not ready to spend that money to ultimately get there. So there's a big carrot at the end of this, but there's a fair amount of cost involved to get there in the first place, and that's right. It's a strategic decision to decide whether that's right for you and for your company.
Yeah, and the timeline too, right? So the kind of the output of the readiness assessment will lay out kind of all the things that need to be done, and a lot of times, depending on who you talk to or different investors, people might have different ideas of what they think is the right IPO timeline, when the company's ready. But this will kind of highlight, what is a realistic timeline, and that's kind of important to narrow down that realistic timeline, because that will kind of have multiple follow-on effects on the work that's being performed.
Christina, do you?
How does your analysis change for a SPAC?
Well, SPACs, generally when we get involved, they're already public. And now what happens is they're looking to buy a company. So when they buy that company, the company ends up going public sort of through reverse acquisition. We personally, as a firm, don't like those transactions because we think there's significantly high risk associated with them. You never know sort of what you're inheriting as part of that SPAC. The vast majority of IPO transactions that we go through, I would say, are traditional IPOs where you file a document, you go through the SEC comments, and ultimately you become public, and there's almost sort of a trading wheels process. There's a number of accommodations as part of that process where things sort of phase in over time. When you get acquired by a SPAC or you get acquired by a public company, a lot of that stuff just kicks in immediately overnight, which is one of the reasons why these things are, significantly risky. The process to sort of prepare should be the same. The problem is if you get acquired by a SPAC, you generally get approached and they want to acquire and they want to do the deal immediately, and you haven't had this year or two sort of lead-in time frame to sort of get ready to be that public company.
You're prepared, you've done the work, you've done the analysis, and you have two options, SPAC or straight IPO.
So if you have those two options, obviously with a SPAC, you might be able to get a higher valuation, and you have the certainty, assuming that the SPAC sponsors hold a significant percentage, you have the certainty that you're going to get a deal done at a price. I think, to Mike's point, oftentimes with a SPAC, you're spending all of your time and energy for a 2 or 3 month period negotiating a merger. And instead of spending those 2 months planning for how to tell your story, how to present your financial statements, and so at the end of the day, it all hits you. Once the SPAC merger is completed, you are public. All of the things that Mike and Samantha would have commented on accounting and reporting, they're suddenly applicable to you, and you might not have had the preparation. The other thing that is worth considering is when you emerge from a SPAC transaction, you don't necessarily have the sponsorship that comes with having done an IPO. And what I mean by that is that part of the preparation with the late stage deal and including a placement agent, part of the IPO process and including multiple underwriters, is that those multiple underwriters are going to make a market in your securities. They're going to provide research coverage, at least for some period of time, and that is going to stabilize the market. So what we often see is that post-SPAC, at least initially, the stock price may go down and there may not be sufficient liquidity, in part because you don't have any natural supporters to make a market in the stock because you truly haven't paid anyone, right? You haven't gotten an underwriter involved and invested. And so it may take a while. And then lastly, and we'll turn back to this, as a SPAC, even though, to Derek's point, SPACs have become increasingly popular, it's hard to avoid them. It's something that every board should think about. Even still, the SEC has an inherent distaste for SPACs. So there are certain SEC rules that penalize any company that starts life as a SPAC. And it's important to understand how that's going to affect the company going forward. Not to mention that the accounting implications are or really something to sort of grapple with and understand early on.
Yeah, maybe just to underwrite that a little bit, or underscore that a little bit, I'll use the underwriter term. You know, traditional IPOs, the auditors in the back of the book, about 70% of those are Big Four firms that go through IPOs. I don't think any of the Big Four in the U.S. audit the SPACs as they go public. Generally tends to be a lower tier firm. Yeah. We're involved in the target company, and then we have to deal with, okay, do we want to stay involved with this company? But that sort of reflects the risk associated with those SPAC transactions.
In your experience, you would walk away from a SPAC after it's completed? We
have many times walked away from companies when they've been approached by a SPAC. That's correct. Okay. So to sort of continue down the path of sort of the scope of getting companies ready, I was just sort of walking through this chart a little bit at a pretty high level, you know, in terms of the areas that companies generally have to add heads. Accounting, obviously, internal controls, and tax. We see a lot of companies that aren't really focused internally on sort of tax reporting, tax structuring. They generally go through an exercise about 6 to 12 months in advance of an IPO to think, do they have the right tax structure to take this company public? We've seen a lot of companies put in some complex tax structures, tax receivable agreements, Up-Cs, et cetera, that add time to the transaction and add time to sort of the overall time to get public. So if you don't think about your tax structure sufficiently in advance, generally it can slow down the process and add significant amount of complications to the deal. And the last one I really just want to highlight, and it probably catches some people by surprise, is the area of executive comp and HR. If you think about the document, you've got what we call a CD&A, a compensation disclosure and analysis section, that even for emerging growth companies can be fairly significant, 10, 20 pages or so. You need to prepare for that. You're sort of going to shine a bright light on your compensation and benefit strategies. And companies that haven't thought about that, sometimes when they shine that bright light, they realize that they're not in line with their peers, and that really can sort of cause problems with the deal. There's also a fair amount of, I call it sort of HR housekeeping, that private companies don't necessarily think about in the area of benefits and expenses and travel and compliance, that as you start to become a public company, you really need to focus on. So when I think about sort of the heavy lift, you know, the areas that we spend a lot of time with companies on in sort of the accounting, internal controls, tax, executive comp, and HR areas, you know, really need to be thinking about all of that stuff, you know, a year plus in advance. And when you think about sort of the competing going public, sort of getting that registration statement ready, you think about sort of getting the company ready to be this public company and this big sort of framework that we have here. Plus, all these companies, they're still doing their day job, right? They're generally successfully companies. You can't sort of take time away from doing that. So it tends to be a fairly stressful time. And I would say the best way to manage their way through that is to have sort of fundamental project management principles in place. What do I mean by that? This sort of readiness assessment that you sort of start with, okay, what's it going to take? What's it going to cost? How long is it going to take? And then from there, go into sort of more detailed plans, put a detailed project plan together, generally in each of the areas that we've got on the framework here, and then make sure that each of these groups are sort of talking to each other. I can't tell you the number of times that we've had some tax group somewhere at the private equity level working on a structure, and late in the transaction, they sort of launched it on the company, and all of a sudden the company said, well, boy, we've been preparing the wrong financial statements all this time. Or, you know, the legal group sort of expecting HR to deliver an executive compensation structure, only the HR group weren't under the tent. They didn't know this was going on, and they weren't planning for it. So putting a strong sort of project plan together that ties all of these to-dos together so that everybody sort of comes to the party or comes to the dance at the right time. And when I think about that, I think about really 3 key milestones. You've got what needs to be ready for that kickoff meeting. You've then got the first filing, and then you've got pricing. And if you think about sort of putting your plan in place to sort of meet at those 3 milestones, so that each of these work streams come together at the right time and deliver their sort of their various pieces at those 3 milestones, generally that project plan and that project management office will sort of coordinate everybody and bring them together. And the IPOs that I've seen, the most successful IPOs, they've all started with a very detailed readiness assessment, let's say a year or 2 in advance. And then they've got strong project management plans or a project management team that sort of pulled everybody together. And on the reverse, the IPOs that have been a disaster, or they've literally taken 5 years to get there, it's because management team wasn't committed, they didn't put a detailed project plan in place, maybe they thought they were going to do a private sale, and then they switched back to the IPO, and then they came and a SPAC approached them, and then they switched back to the IPO. And it's just, there's really never sort of a strong strategic plan or a strong project management plan in place, and they've sort of bounced around. And I have literally worked on companies where it's taken them 7 years to sort of get there, and it's because they haven't really been committed, and they haven't put that sort of strong plan in place.
How far in advance?
No, go ahead, Eric.
How far in advance do you see companies upgrade their investor relations, and do you like to see them use some of the third-party consulting firms or more in-house?
Yeah, investor relations is interesting, and it's obviously on the list here, and the reason I didn't highlight it is because it tends to sort of get later in the process. I think most companies that I work with, very initially, they sort of rely on sort of their banks a little bit for some investor relations advice. As they get closer, they outsource to sort of the small boutique type firms. Maybe after they become public, they start to reposition some people, think about, putting somebody in-house, but it generally tends to be one thing that on this list that gets pushed later in the process than earlier in the process. It's going to take a long time to get that sort of accounting house in order, get the audited financial statements, get your projections in place or a function to be able to produce those projections. The investor relations sort of play a little bit of catch-up. So, maybe as you get close and you know that you're actually going to be a public company, that's when you can start sort of hiring. Whereas a lot of the stuff that I talked about, generally it's sort of pretty good just corporate governance to put some of that stuff in place. And you don't really need to be actually going public to sort of do all that stuff. But it's very hard to hire an investor relations person, quite frankly, almost until you're guaranteed to be a public company.
Okay, well, we probably have about 4 more hours that we could discuss, but we don't. So if anyone has any questions or anything to say, we'd be happy to listen or hear that. But also, all our firms have all kinds of materials. We've given you a packet of materials, but we have materials on almost every aspect of the either late-stage private financing or IPO. So, and we're happy to give you more specific things should you want them. And so thank you for coming and participating. And I thank my 3 ex-associates for coming. That was lovely. And we look forward to seeing you all at some other events or to hopefully working with you. Thank you.